13 of 21 series are aligned with a stagflation mild configuration this morning. That is a weak but meaningful level of agreement across the macro grid. The current macro regime is stagflation mild, with a confirmation score of 13 out of 21. In this reading, the macro regime is defined by growth momentum decelerating at roughly -0.12 on the framework's growth composite, while inflation momentum is accelerating at about +0.01 on its inflation composite. The coherence score is characterized as moderate, meaning the 21 series the framework tracks are not fully synchronized, but still cluster around this stagflation mild pattern. And the confirmation score is again 13 out of 21. By our historical base rates, a regime with this confirmation score persisted in about 29% of comparable cases over 3-month windows, with the most frequent next configuration recorded as a contraction-type regime. Compared to last week, growth momentum has softened inside the framework, even as the Atlanta Fed's real-time GDP tracker improved over the past 2 sessions, a reminder that different growth lenses can move in opposite directions. Historically, environments that the framework has labeled this way have felt like slow, uneven tapes for broad stock indexes, with more action in relative sector performance and in assets like gold and long bonds. A record of past behavior, not a forecast. Starting with yields, the 10-year Treasury yield is around 4.74%, with the 2-year near 4.24% and the 30-year close to 5.27%. So the curve is modestly positively sloped between the 2-year and 10-year points, while long rates remain elevated. The engine marks this configuration as red for growth-sensitive yields, defined quantitatively as an upward rate of change in long-term yields and a curve spread between the 10-year and 2-year of roughly 0.46%. Investors watch this because it speaks to how restrictive longer-term financing conditions may be and how much term premium is embedded in bond markets. The question it raises is whether this level and shape of the curve changes how much duration risk or credit exposure participants are comfortable carrying. In our framework's reading of comparable periods, this roughly coincided with episodes where bond total returns were choppy and term premiums moved around over the following 1 to 3 months. A record of past behavior, not a forecast. What would challenge this read is a decisive move lower in long yields, or a renewed inversion of the curve that shifts the engine's momentum labels back toward neutral. On the labor and real activity side, non-farm payrolls, the broad measure of employment, and the Chicago Fed National Activity Index, a composite of production, income, and consumption, both feed into the growth composite that is currently decelerating. These series are effectively tagged red in the framework when their rate of change slips compared to the engine's baseline, indicating softer incremental momentum even if levels remain solid. Markets watch this because labor and broad activity data shape the narrative around how durable the expansion is and how much resilience underpins corporate earnings. The question investors often ask in this configuration is whether a softer growth pulse, combined with sticky inflation momentum, alters the balance of risk between defensive and cyclical allocations. In our framework's reading of comparable periods, this roughly coincided with stretches where equity breadth narrowed and cyclical sectors underperformed more defensive areas over the subsequent quarter. Again, a record of past behavior, not a forecast. What would challenge this interpretation is a renewed acceleration in payroll growth or a clear rebound in composite activity gauges. Credit conditions provide a third lens. High-yield credit spreads, which measure the extra yield investors demand to hold lower-rated corporate bonds, have not blown out but remain sensitive to the evolving macro mix. In this environment, the engine would tend to mark credit as yellow if spreads drift modestly wider without a full stress episode, defined quantitatively as a mild positive rate of change in spread levels compared with the recent trailing window. Markets follow this because credit spreads often reflect the balance of risk appetite and default concerns. The question it raises is whether the price of credit risk still matches each investor's tolerance as growth cools and inflation momentum runs hotter. In our framework's reading of comparable periods, this roughly coincided with phases where credit total returns lagged high-quality government bonds over the next several weeks to months, a record of past behavior, not a forecast. What would challenge this configuration is a meaningful tightening in high-yield spreads, or conversely, a sharp widening that shifts the label to deep ready. For the fourth signal, consider equity sectors and commodities together. Technology stocks, as represented by broad sector indexes, have softened, while financials, utilities, real estate, gold, and long bonds have advanced, and crude oil has retreated. The framework effectively tags gold and long-duration bonds as green, defined as a positive rate of change relative to their baselines, while technology is closer to our RAD. Markets watch these rotations because they often encode how participants are rebalancing between growth-sensitive assets and perceived defensive or real asset hedges. The question this setup poses is whether these rotations confirm or challenge an investor's existing positioning across growth, value, and real assets. In our framework's reading of comparable periods, this roughly coincided with stretches where broad indexes made limited net progress, but dispersion across sectors and asset classes mattered more over the following weeks. A record of past behavior, not a forecast. A sustained reversal, with technology regaining leadership and gold and bonds rolling over, would challenge this interpretation. Two conditional triggers sit on the map this morning. First, if the 10-year Treasury yield crosses 4.45% and holds there for 5 consecutive sessions, in our framework's reading, stronger inflation composites appeared in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. In regime terms, that configuration historically increased the mathematical case for a shift from an expansion style to an acceleration style inflation backdrop within the framework's labels. Second, if the widely followed Fear and Greed Index drops below 15 and stays there for 5 straight sessions, in our framework's reading, the regime's confirmation score deteriorated in roughly 7 of 9 comparable cases. Again, a record of past behavior, not a prediction. In those historical episodes, the engine recorded an environment where macro signals were less synchronized, prompting a formal lowering of confidence in the prevailing regime label. The map is live. These conditions are being monitored daily across all 21 series. The Given engine is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, the engine records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the engine. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use the engine to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. The Given engine monitors all 21 series and 407 symbols as mathematical configurations, independently of regime labels, so members can see how conditions have behaved in past environments, not as promises of future results. The Given engine runs the framework. You study the outputs and environment. You decide what to do next. These readings are potential, and educational by design. Every trading day, this is free. Watch real symbols go active in live markets at the price it's happening, see which sectors are leading, and learn to read what's driving it yourself. That live view is the observation desk, the same 21 series and 407 symbols founding members study each morning, the environment underneath every move. If you want to watch it alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members. Watch it before you risk $1. You decide.